At the start of the year, I made the prediction that SOFI gets to $28.50 by the end of 2025, breaking past its previous all-time highs. However, there were some things that actually came out during their most recent earnings call that made me reconsider my valuation, especially that 7% dilution. Because right now, I can actually see SOFI closing out 2025 at $31.68 if the entire economy holds up. Now, whether or not the economy actually holds up, it's entirely out of SOFI's hands. But what they do control, however, is the fundamentals of their business, and that I can show you step by step how we get to that $31.68 price. But as always, potential is a dangerous word, so let's dive in. Now, if you actually listen to the earnings call, I think what you would realize is that none of the analysts really asked any questions that gave us any new insights into SOFI's business. And if you were to sum up the quarter, it's primarily more of the same but much better and at higher margins. Now, I think I really just want to base this entire video mostly off Chris Lapointe's answer to some of the analyst questions regarding expectations for SOFI in the back half of 2025. And so this is where we're going to start. Now, the first thing I want to point out is that when it comes to financial services, Chris Lapointe and SOFI's management knows that they're pacing well above their guidance of 60 to 65% year-over-year growth, and they tell us that they expect this to continue into the back half of the year. Now, what does this mean in terms of pacing well above their guidance of 60 to 65% is really up for interpretation, and later when you take a look at the numbers, you can actually decide for yourself whether or not you agree with my assumptions. And the second thing that he actually tells us is regarding the tech platform and lending, where they say they expect low double-digit to teens year-over-year growth. Now, I think this is more suitable expectation for the tech platform, but I think that is a slightly conservative estimate when it comes to their lending segment of the business, because the caveat over here is that in Q2 of 2025, that actually represented the third consecutive quarter of accelerating lending growth. And so they really haven't grown lending at such a slow pace since the third quarter of 2024. Now, if you consider, some of the debacle around the recent job revisions and uncertainty around the economy, I think the chances of a rate cut in September has significantly increased. And I think because of that, we continue to see an acceleration in lending in the back half of 2025. Now, if you look at the growth rates of lending in the first and second quarter of 2025, these actually came in fairly strong at 27% year-over-year and 32% year-over-year respectively. Now, granted, if you consider the growth rates, you are comparing this with Q1 and Q2 of 2024, where SOFI intentionally withheld how much they were lending, and those were intentionally weak quarters for lending. So that's why they do have easier comps. But I guess with the acceleration of lending due to rate cuts, you would expect them to be able to at least maintain growth rates here in the low to mid 20% range. And so usually just considering these three aspects of SOFI's business would be sufficient to actually do a simple valuation of their business, but the dilution changed that, and I'll talk about that in a bit. But if you really want to understand SOFI's valuation, you have to start by understanding what drives their growth, and that is the member count as well as product adoption. Now, the member count is really a portion of SOFI's business where I kind of underestimated management in the first half of 2025. And this is primarily because management ended the year in 2024 telling us that they only expected to add 2.8 million members onto their platform for the whole of 2025. And for me, every time, despite knowing that management tends to give conservative guidance and then beating their own guidance, there's always a slight concern there that they may intentionally withhold this growth, like what they did with the lending platform previously, due to their conservative nature if there's some uncertainty in the economy. And so because of this, I initially expected SOFI to grow their member count at 30% or the low 30% range year over year for the whole of 2025. However, if you take a look at the numbers, they have actually grown their member count by around 34% year over year in the last two quarters. Now, in fact, in the most recent quarter, in Q2 of 2025, they have increased their guidance on the total number of members to be added onto the platform, right? So this number actually increased from 2.8 million, which was their initial guidance in the end of 2024, to 3 million members in Q2 of 2025. Now, this tells us that SOFI expects minimally to end the year with 13.12 million members onto their platform, right? Because at the end of 2024, they had around 10.12 million members. Now, with the numbers that SOFI currently has put put out in Q1 and Q2 of 2025, that has actually even made the new guidance of 3 million members added overly conservative. Now, let me break it down for you. SOFI currently has around 11.75 million members on their platform. Now, in order for them to add 3 million members onto the platform and reach this 13.12 million member number, they would need to add an additional 1.37 million member over the next 2 quarters, right? So if you average this out, this averages out to around 685,000 net new members added in both Q3 and Q4 of 2025. Now, the last time they added members in the 600,000 member range, that was back all the way at the start of 2024. So I think there's no real logical explanation to think that they will regress in terms of their ability to grow members to the pace that they were growing at in the first half of 2024, where they were intentionally being conservative. So if you take all of these things into consideration and you just model out a 33 to 34% year-over-year growth in terms of member count for the rest of 2025, that gets you to 13.5 million members on their platform by the end of 2025. And, with their own projections getting us to 13.12 million members, I think ending the year at 13.5 million members really isn't too far-fetched and isn't out of the realm of possibility. And then when it comes to products, this is actually pretty straightforward. The number of products per member should stay at 1.46 products per member in the third quarter of 2025, barring any announcement of new products being launched this quarter. I expect that, if Powell cut rates in September, we should see the effect of these rate cuts increase loan originations even more in the back half of the year, in Q3 and definitely in Q4. So I think my assumption here is also in Q4 of 2025, we would start to see some rollout of their crypto products, and perhaps with the momentum of the rate cuts as well as the rolling out of new products and even things like level 1 options, we should see the products per member number start to rise in the fourth quarter of 2025. And so the expectations over here is that this number raises from 1.46 in Q3 to 1.48 products per member in the fourth quarter of 2025. And then when it comes to monetization, here is where it starts to get a little bit difficult to project out the numbers, because what you're going to realize as you work on the numbers is that some very small tweaks in the monetization numbers will lead to huge upside in terms of revenue and profitability, to the extent that it may come across as overly bullish. Now, I'll show you some of the effects of this later on, but let's take a look at this monetization number in light of what Chris Lapointe has told us. Now, in the earnings call, he actually told us that SOFI expects Q4 to be higher than Q3 across all of their metrics, which means revenue, adjusted EBITDA, net income, as well as earnings per share. Now, for that to happen, the implication is that it has to be driven by both lending revenue and financial services revenue, because these two business segments are currently the fastest growing and highest margin business, and these will definitely be the growth drivers in order for this to happen. So let's assume lending revenue per product comes in at $197 in Q3, up just $1 from Q2. And with rate cuts around the corner, let's assume this continues to rise in the fourth quarter of 2025 to $200 of lending revenues per product. Now, to me, I think these numbers are fairly reasonable, because what you're going to see with these numbers is that the lending would grow year over year in the low to mid 20% range in Q3 and Q4, and on an aggregate, lending growth would come in at 26% year over year growth. Now, moving on to financial services, Chris Lapointe has told us that currently they know financial services is pacing well above their own guidance of 60 to 65% year over year, and he expects this to continue in both Q3 and Q4. And again, like he said, Q4 will be faster than Q3. Now, financial services revenue per product came in at $24.50 last quarter, up from $22 the previous quarter. So the assumption here is that this goes up to $26 in Q3 and then up another dollar to $27 in Q4 of 2025. Now, I want you to actually see how this actually works out, right? So assuming $26 of financial services products revenue, or revenue per product in Q3, and $27 in Q4, this would actually represent a 75% and an 82% year-over-year growth respectively. And I think this number really makes sense because it is well above the 60 to 65% guidance that they have given. Now, some people may say 75% is not well above 65%. I mean, honestly, to each his own. For me, personally, finally, I'm bearing in mind that in Q3 of 2024, that was when they first launched their loan platform business, and that is when we first saw a spike in the financial services revenue. So in order for them to continue keeping up this 100% year-over-year gain is going to be hard, right? So because of that, I do think a 70% to 80% year-over-year growth is actually already considered fairly bullish for the company. And if you aggregate all of their financial services revenue for 2025, the full year 2025 financial services revenue would come in at a 88.7% year-over-year growth, which is well in line with guidance. And then finally, it comes to the tech platform. And for me, this is the easiest segment of their business to project out in 2025 because management has already, in a sense, told us that the entire tech platform is going to be a write-off for this year. So in the last quarter, tech platform's revenue grew by 1% year-over-year. So I'm just expecting a 1.5% increase in total tech platform account in Q3 and 2% increase in tech platform accounts in Q4. So like I said, this year is a write-off for the tech platform because we are expecting growth to re-accelerate only in 2026. And so that's what I'll be pricing in. Revenue per account to come in at 70 cents, up from 69 cents in the last quarter. So putting all of this together, you'll get tech platform revenue in Q3 and Q4, both above 110 million, but just, right, 113 million in Q3, and I believe 119 million in Q4 of 2025. So like I said, if once you put all these three business segments together, the full year revenue for SOFI would come in at around $3.63 billion, and this would represent a 7.7% beat of their current guidance. Now, once they raise their full year guidance again in the third quarter of 2025, we are going to expect the margin of this beat to start to narrow down into the 6% range, which is well within the range of possibility. Now, I just want to point out to you how easily SOFI can actually ramp up their growth in the coming quarters ahead, assuming the tech platform revenue stays as what we have assumed previously, 113 million in Q3 and 119 million in Q4. Now, all we are going to do is adjust some of the monetization numbers in both the lending side of the business as well as the financial services side of the business, and you are actually going to see that actually some of these numbers might seem a little bit on the bullish side, but it's not something completely out of the realm of possibility. Now, if you take a look at the lending segment of the business and you increase the lending revenue per product to $205 in Q3 and $210 in Q4 instead of $197 and $200 that we were using, what you're going to end up with is that Q3 lending growth would come in at 27% year over year, and Q4 lending growth would come in at 31% year over year. And what this means is that they do not accelerate their lending growth from Q1 and Q2, but they're able to maintain that growth rate from Q1 and Q2, because with $197 and $200 of lending revenue, we are assuming a deceleration in the pace of lending growth. But with $205 and $210, we're assuming that they're able to maintain the pace of lending growth. Now, I didn't pluck these two numbers out of thin air. If you take a look at Q3 and Q4 of 2024, their lending segment was actually operating at this exact number, right? Producing $205 of lending revenue per product in Q3 of 2024 and $210 of lending revenue in Q4 of 2024 as well. Now, moving on to the financial services side of their business, if we are going to assume $27 and $28 of financial services revenue per product instead of $26 and $27, this means that in Q3 of 2025, financial services revenue would come in with an 81% year-over-year growth, and Q4 would come in at 89% year-over-year growth. Now, this would actually represent their second and their fourth slowest growth in terms of their financial services side of their business over their last 12 quarters. And if you look at these numbers, I think some people might consider them a little bit too bullish for the company, or at least not giving yourself enough margin of safety in terms of your assumptions when it comes to the valuation process. And so because of that, I've decided not to use these numbers and keep to my original numbers. But if SOFI actually does achieve these numbers, it's unlikely that SOFI stays below $30 per share, and I'll be definitely pleasantly surprised by that. Now, all of the discussion so far gets us to SOFI's top line number. However, in my previous video, as well as earlier on in this video, I've alluded to the fact that incremental margins can potentially change the way we value SOFI's business. You see, I think by now most of us know that SOFI's long-term target is to operate their business at a 30% adjusted EBITDA margins as well as a 20% net income margin. And their North Star in order to get to these numbers is their incremental incremental margins, and they track that every single quarter. However, they have always tend to operate at a higher incremental margins compared to their long-term targets. But if you take a look at the trend in Q4 of 2024, SOFI intentionally kept the incremental margins low after operating at a high level for the entire year. And they did that so that they could reinvest into the business, and they prioritized reinvestment into the business over posting a larger beat on their earnings per share. And so therefore, because of that, I'm not going to assume that they're going to continue operating at a strong level for the entire year, because in Q2 of 2025, they operated at a 40% above a 40% incremental EBITDA margins, as well as 30% incremental net income margins. So like I said, I'm not sure whether they are going to be keeping this up for the entire year or just keeping this up for Q3 and then tanking their margins in Q4 to reinvest into the business. And so because of that, and to account for that fact, what I'm going to do is that I'm going to assume a lower number and average it out over the next 2 quarters. So my assumption going into this is a 32% incremental EBITDA margins over the next 2 quarters and a 23% incremental net income margins over the next 2 quarters, because I believe SOFI aims to drive sustainable long-term growth, and I don't believe that they're going to choose to post a huge beat over the ability to reinvest into the business. With these assumptions, the full year adjusted EBITDA number should come in at around $1.026 billion versus the $960 million guidance, and this actually represents a 7% beat. And their full year net income would come in at $421 million versus the guidance of $370 million, and this actually is around a 14% beat. And once again, this isn't too far-fetched because we already know how SOFI operates, and there's a high chance that in Q3 they are going to raise their full year guidance once again. And once you look at these numbers in light of their new revised guidance, it's going to result in an even more conservative beat. Now, the reason why I'm being so conservative in terms of my margin assumptions is not because I'm bearish on the company. You have to understand where SOFI is in the business cycle and how the management is looking at the company. And if you take a look at what Chris Lapointe has told us, he said that we want to compound 25% revenue growth for decades and not just years. We don't want to under-invest in the business. And because SOFI is prioritizing reinvestment back into the business, that is why I don't think that they're going to, give up the opportunity to reinvest into a business just to post a higher than expected revenue and profitability beat. And after discussing SOFI's revenue and profitability numbers, we need to tie all this in with our understanding of the dilution that they just announced and how that affects their earnings per share. However, before we get into the details, let's just lay out some of the facts of this dilution. Now, if you take a look at the number of shares outstanding, SOFI currently has around 1.18 billion shares outstanding, and what we are told is that they plan to issue an additional 71.94 million shares and an option for the underwriter to purchase an extra 10.79 million shares. Now, I'm assuming over here that the option to purchase the extra shares will be exercised, and this brings the total diluted share count to 1.265 billion shares in the third quarter of 2025. This would represent an additional 82.7 million shares. Now, I'm also going to assume an additional 2% dilution in Q4 of 2025, bringing the entire share count to 1.29 billion shares at the end of 2025. And these are the numbers we are using for our EPS calculations. Now, I just want to be very clear. The numbers that we are using over here are not my actual predictions for the Q3 and Q4 earnings over the next 2 quarters, because there's still quite some time between these 2 earnings and many things that can happen. Many announcements can take place between now and then, which may cause me to change some of my metrics. But what I'm doing over here, or the exercise that we're going through, is to show you how with the current assumptions, if we adjust the incremental margins and to account for the dilution at a very high level, how this actually affects SOFI's valuation. And so with these numbers, you're getting an earnings per share of around 9.4 cents in Q3 and 10.4 cents in Q4 of 2025. Now, why am I showing you these numbers in 3 decimal places? Because the earnings per share number are usually rounded to 2 decimal places. And when you do that, sometimes when you add the quarterly numbers together for a full year, that's where you see certain discrepancy in the numbers. So I'm laying this out, these 3 decimal places, so you can see exactly how we get to our full year earnings per share of 34 cents versus the 31 cents that SOFI has guided for. Now, currently on a trailing 12 months basis, SOFI's earnings per share comes in at 25 cents, and they're currently trading at $22. And so if you do the math, this represents an 88 times PE. Now, if the economy holds up, if the macro holds up, then I'm assuming that this multiple will not change too drastically from here. And I'm assuming at the end of the year, if they do post a 34 cents EPS and we apply this 88 times PE to that, we get a possible price target of around $29.92. But wait a minute, didn't I say we're going to get to $31.68? So how do we get from $29.92 all the way up to $31.68? And to understand how we get there, we have to understand what the dilution does for SOFI. So let me break it down for you simply, and please understand that this is a simplification of the entire setup, and this is not how SOFI's business is actually structured. Of course, it's a lot more complicated than that, but I'm just using this example to demonstrate a principle over here. Now, imagine you open a coffee shop with 9 other friends, so there are 10 of you in total, each of you owning a 10% stake of the coffee shop. Now, apart from that, you also take out a $100,000 loan from the bank at a 5% interest, which amounts up to $5,000 of interest payments every single year. Now, every year, this coffee shop makes around $25,000 in profit. You pay off the $5,000 loan, and each of you split the $20,000 that is left over evenly, and you each receive $2,000 of the profit. Now, assuming someone comes in and gives you $100,000 for a share of the business, now this means the profit has to be shared 11 ways instead of 10, and that is why, by and large, investors are unhappy with the dilution event, right? Imagine the $20,000 profit having to be split 11 ways instead of 10. Each one of you will receive less of the profit. However, this is where the nuanced discussion takes place. Now, if you take the $100,000 given to you and you pay off the $100,000 in debt that you owe to the bank, now after paying off the debt, you actually save on the $5,000 of interest payment every single year. And instead of splitting $20,000 10 ways, what you end up with, without having to pay the $5,000 interest, is that you split $25,000 11 ways. And if you do the math, that works out to $2,272.73 for each person. So now, although each one of you owns a smaller slice of the pie, you actually take home more money. And so the nuance over here is that dilution is bad if done from a position of weakness and if the capital is actually used to continue running the operations of the company. However, if it is done from a position of strength and allocated in a way where the capital can boost earnings at a percentage that is higher than the dilution, this can actually be accretive to shareholders. Now, with this in mind, let's take a look at how SOFI's management has spoken about the dilution so far. Now, on this post in X, SOFI basically told us that the dilution gives them the flexibility to either grow organically or inorganically, which I guess means through mergers and acquisitions. However, they did clarify that no acquisitions are currently being contemplated, and another possible use of this capital raise is to pay down expensive debt. Now, previously, when I was looking for potential acquisition targets, I also came across this post by DDI where he suggested something about using this capital to actually pay off some of the revolving credit facilities. So when I did a little bit of digging myself, I just went to find the interest rates that SOFI are paying for this debt facilities, and this ranges anywhere between 4.9 and 6.2% in terms of interest for their debt. So with the 82.7 million shares issued at around $20.85, SOFI would have raised around $1.725 billion. Now, they may or may not use all of this capital to pay down the debt. The assumption over here is that they do, but of course, if they don't, then this calculation will be a little bit off, right? So the assumption over here, like I said, we are assuming that all of the entire capital being raised, the $1.725 billion, goes to pay down this expensive debt. And you can see over here in their latest reports that the interest paid on their warehouse facilities works out to be around 5.23%. So if they pay down $1.725 billion worth of debt at an interest rate of 5.23%, that would save them around $89.7 million on an annual basis, which means, if you work it out on a month-over 12-month basis, they save around $7.47 million per month in terms of interest payments. So between August and December, that is a 5-month period, they will save around $37.38 million, and that is accretive to their bottom line. So you add that on to the $421.9 million we were talking about earlier, that brings their total net income to $459.28 million for the whole year of 2025. And if you consider that they have 1.29 billion shares in the fourth quarter of 2025 after accounting for the dilution and a further 2% in the later part of the year, then we get a full year EPS of around 36 cents. Now, if you apply an 88 times PE to that, that's how you get $31.68. And that is why I believe through this dilution, it is possible that it actually boosts the earnings per share for SOFI. And because of that, that is how they get above $30 per share by the end of 2025. However, if you want to find out my longer term valuation for SOFI over the next couple of years, I speak more about that in this video over here, and I will see you in the next one.